Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Howard Marks. After attending Wharton and getting an MBA from the University of Chicago, Howard started his career at Citibank. Eventually, Howard started his own firm in 1995 called Oak Tree Capital Management, which is in charge of $90 billion worth of assets. Howard is the author of The Most Important Thing, Uncommon Sense for the Thoughtful Investor. According to Forbes, Howard is one of the richest men in America. Let's ask him 5 good questions. Hi everybody, my guest today is Howard Marks, author of The Most Important Thing. Howard, where are we talking to you today?
I'm in New York.
Great. Looks like we got a nice view out your window there a little bit and some babies in the background.
Right. I just became a grandpa this year.
Congratulations.
Thank you.
So Howard, let's jump into our 5 good questions. The first question, number 1, your book came out in 2011. Is there anything that you would add to it since then? Anything that, maybe a recent anecdote that really nails one of your core principles in the book?
No, I don't think so. I think, I did. There has been an updated edition called The Most Important Thing Illuminated. And in that, I did add a 21st chapter. It was actually something that fell on the cutting room floor the first time around when the editor said it was too much, and I decided that it was lacking. So now there's a chapter that says the most important thing is reasonable expectations. And I think that's a pretty good rule for life.
Yeah, I've heard it said before that, like expectations minus results equals happiness?
Well, that's probably a good point.
Yeah. Okay, question number 2. Your book is, I think, one of the best books on investment philosophy that I've come across.
Thank you.
I put it up there with, Benjamin Graham level type work. And it does an amazing job of explaining both the investment process and also risk, and also just in general, like expectations about investing. It's clear that you spent a lot of time really deeply thinking about the investment process. Is that something that was just kind of innate to you, being very philosophical, or is it from just observing markets for so many years? Where did that come from? How'd you get so thoughtful?
Well, I think it's all of the above. The one thing I can tell you is that it was never intentional. I didn't set out to develop a philosophy, but rather I lived life and obviously had a lot of experience and was subject to a lot of resources and inputs, including the things I lived, the things I read, and so forth. And over time, I guess you would say, kind of gleaned snippets here and there, which for me came together for something which I think is cohesive, even if not concise.
Sometimes that's hard to do.
Right.
Great. So I have question number 3. I keep a Google Doc where I capture all the great quotes that I come across in my reading. And most of the time I'll get like 1 or 2 good quotes out of a book. But with yours, it was literally like maybe a couple dozen.
Thank you.
So one of them I'm going to read to you, and then I'm going to ask you a question about it. Here it is. It's one thing to have an opinion of the macro, but something very different to act as if it's correct. Now, the question behind that is, obviously, timing like the perfect top and bottom of markets is impossible to do. No one's ever been able to do it consistently. But what's your thoughts on certain like macro valuations, like market cap to GDP, Tobin's Q, Shiller PE? Do you think that those can inform an investor on maybe when is the time to really be searching hard for investments, and when is it maybe better to go take a vacation because you're going to be reaching for something?
Right. Well, I think that it's very. Somebody took the model from the book and did a spreadsheet and sent it back to me, and it kind of said, "Hold your wallet or spend your wallet." Those were the two extremes, and I think it's very important in order to figure out which of those to do. That is to say, think about investing or think about conserving. Is to not do 2 things. Number 1, observe valuations, like the kind of things you talked about. And the other thing is observe what's going on around you. Observe the behavior of people. That will tell you whether there's mindless excitement in the market, which is dangerous, or total terror, which can make buying very attractive. But I think that it should be the combination of the two, and observation of those valuation ratios is very important. Although, as my first boss used to say about economists, they should be on tap but not on top. So we shouldn't do anything just because of a ratio, but it should start us thinking.
Yeah, I think that's good advice. So you're the founder of Oak Tree Capital, and it's a massive firm with $90 billion under management, and mostly in the distressed and high yield debt space. I had a question about how do you balance being a bottom up kind of investor with and generally market agnostic with in a fixed income space, which is a lot of times buffeted by more macro things going on with interest rates and fluctuations there. How do you it seems like the tide could pull particularly strong on your portfolio. How have you done it?
Well, number one, remember that in fixed income, the tide can pull on the portfolio. The macro events can pull for a while, but in the end, they're not dispositive. If you buy a bond from a company and they promise they'll pay you interest and your money back in 10 years, in the long run, the only thing that matters is whether they keep that promise. In the short run, the bond can go up or down in price. But in the end, if the company is creditworthy, you'll get your interest and you'll be repaid at the end. So I think that short-term timing is not that important in fixed income. And, bottom up is much more important, which is to say, which bonds will you buy? Which ones will you exclude? In distressed debt investing, you have to be really attuned to these things. In distressed debt, that is the debt of companies that are either bankrupt or expected to go bankrupt. Interest rates, the directions of market prices are not the important thing. The important thing is whether there are enough assets in the company to cover your claim. So that's a very specific, very detailed bottom up. And in the short run, that is by far the most important.
Great. Thank you for that. Question number 5 is, you've obviously done very well for yourself. Money is probably not a motivation at this point. What does keep you motivated to keep working, and what do you want your legacy to be?
Well, I think the best reason to work is when you have enough money to eat, is that you should have a good time. You should enjoy yourself. You should like what you're doing. You should feel you're making a contribution. And I do those things. I love the things I do day to day, including writing, speaking, ideating, philosophizing, and leading the organization. And, Bill, in the 60s, yes, there was a rock club in San Francisco called the Fillmore. And it was run by a guy named Bill Graham. And he said, it's only work if you'd rather be doing something else. And I love what I do. I can't imagine where I would get my satisfaction if I didn't do the things that I do. I'm tempted to say I would do it for nothing, but in fact, I do. I'm not paid at Oak Tree to work. None of the founders get a paycheck, a salary, or a bonus. And all we get is our share of the company's profits. Now that we've gone public and we have stock, I'll get that share of the profits whether I work or not. So I really am, in the literal sense, working for nothing. But I'm glad to do it because I love my work. What was the second part of your question?
What would you like your legacy to be?
Well, I'd like people to say that Oak Tree was a rare investment organization that had consistently good performance without the ups and downs, that made a lot of money for its clients with the risk under control, that behaved in a way that was marked by integrity, and that put its clients first, and that it was a good place to work for the employees, and that the success of the firm and the founders was shared with all the employees. If I could go out with that, I'd be pretty happy.
That's great. And then we have our bonus question that we always ask, and it's about a book recommendation. And what we're looking for here is something that is it kind of underrated, maybe underfollowed, kind of more obscure pick that you don't think has gotten the appreciation that it deserves?
Well, I like the book "Fooled by Randomness" by Nassim Nicholas Taleb.
Uh-huh.
I think it's got some very, very valuable ideas, and understanding risk and dealing with risk and uncertainty is a very big part of investing and also of life. And I think that it's easier to conceptualize risk and uncertainty if you start from the premise that the underlying process is fairly disorderly, and that the results, there's a tendency to say that the future is uncertain, but the past is history. The past is in the books. But I think if you look at the past and you say to yourself, lots of different things could have happened. Only the past that actually happened and was recorded in the history books was only one of the many things that could have happened. And but for randomness, the others would have happened. I think if you look at history that way, it informs how you look at the future. So, I recommend "Fooled by Randomness" to everyone.
Great. Howard, we really appreciate you coming on our show, and everybody pick up The Most Important Thing if you want to really take your investment philosophies to the next level.
Thank you, Jacob.
Thanks, Howard.